Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. You know, we have so much information in this roundtable, we had to break it up into three parts. There was just no other way. Looking ahead to the new year, if you had $100,000 in fresh cash to invest for all of 2009, how would you do it? Our panel members can tell you how they would do it. Steve Reitmeister, our editor-at-large at Zacks.com. Charles Rotblatt, our senior market analyst. And, of course, Zacks top stock screener, Kevin Matris. So it's kind of an interesting question now as we come up to the end of an old year, look ahead to the new year, given what we've all been through here in these markets. I guess the obvious question is, where do you think the economy and the markets are headed in 2009?
Yeah, the two are so tied together, and we so often hear about how the market rebounds 4 to 6 months in advance of an economic rebound. And so really, for me to set my picture for 2009 and how I'm going to invest in that in the year ahead, I got to take a look at the economic outlook as it's going to set the paces. So many people are talking about an economic recovery in the second half of 2009, and I think that's just a little too comfy to keep saying that, okay? Because we kept talking about a end of 2008 recovery, early 2009. I think that what people have to realize is that the Fed and the government are not just giving away this money for fun. Mm-hmm. Okay, there are serious problems out here. They are doing historic changes, historic stimulus, right, because there is serious problems out there. So our economic downturn, our recession started in December of 2007. We are heading into our second year of that. And yes, it is possible that we have a second half rebound, but I think it's probably going to be pushed out a little more to 2010, which still could mean a stock market upturn in late 2009. So I'm bearish going into the first half of the year, mm-hmm, and going to start to look for some opportunities in the second half of the year. And so that's really the way I'm kind of breaking up the year. Okay. And just to kind of point it out here, I got a picture. I think there's some excellent parallels here of what 2008 and 2009 looked like compared to what 2001, 2002 looked like. So this is the chart of 2001, 2002, and then the rally of 2003. If we start to the far left, okay, 2001, we have the popping of a bubble the year before, the internet bubble. We have a soft economy, and then all of a sudden, in September 2001, we all know 9/11 occurred, and a dramatic downturn in the market. But it wasn't just the explosion of the Twin Towers. It was also what happened to the economy afterwards, and all the layoffs that happened afterwards, and the fear that run amok. But take a look. See how it hits a bottom in October 2001, and the market kind of rebounds for a little while because there's optimism, okay, or false optimism, mm-hmm, okay? And what I'm trying to say is, if you take a look at what is happening here in that second half of 2002 as it starts to fall and it starts to find a new bottom, I believe that is very much what 2009 will look like. We get a new president, and we have all this stimulus, and there's optimism, there's going to be a second half rebound, and then, oh no, it's a bear trap and it's eating me alive. And that's where the real bottom is, about a year out from now, October or November of 2009, and that's what I'd be betting on. So that is my outlook.
I fully expect him to start using sound effects.
Bear trap, yeah.
As he starts describing these future charts. So are valuations cheap?
I mean, people want to say that valuations are cheap based upon historic valuations, but the thing they have to understand is the market goes through fear and greed cycles. And so as you push towards the fear, that the valuation is not fully fearful yet. And especially we here who take a look so much at earnings outlooks, that the earnings estimates will continue to come down as this economy, as the unemployment keeps rolling in, as the economy suffers, and so earnings estimates will come down, the PE will come down, and that's why, unfortunately, I don't think we've seen bottom yet.
Well, I don't know about anybody else, but I know they're eager as all heck to hear the investment strategy.
Yeah, so really I got a first half and a second half strategy given my outlook for things. So the first half strategy is we're going to trade. We're going to trade like crazy. Every time the market goes up to around 9,000 on the Dow, we're going to short, okay? And we're going to short, and we're going to use things such as ultra ETFs, ultra short ETFs, and we're going to take those silly market rallies that shouldn't be happening, and we should be riding them down. Every time we move into the 7,000s, and test this bottom again, we're going to flip it around, and we're going to trade back up, and we're going to trade up and down. And for as crazy as that may sound, I just got to say personally for myself is that last year I got caught off guard like a lot of folks. In September I'm down 30% on the year, and this is how I got myself back, and now I'm -4 on the year. And so this is how you got to do it. This is what the environment offers, and I've been riding up and down using ultra ETFs to get back to barely about break even, which I think most people would be fairly happy with, and that's what the first half of the year is going to offer.
Well, it's not as crazy as it sounds, because I was just reading somewhere, and in fact, I think I mentioned to one of you two guys in a private conversation that if you would have been just trading the bear market rallies here that we've seen in the past couple of months, you could have been making some considerable profits in the stock market. But is it for the average investor on the street? Is that a prudent strategy?
That's an excellent question. For the average investor, if they just want to go to cash on the rallies, and then sell off and go a little more cash, or here again just go with more defensive stocks, they can go that route as well. If you want to fight back a little bit about what the market's offering, then what I'm saying is not super aggressive. I don't think it's like off the charts ridiculous, but it is a little bit more. It is a little. You are trying to time out the market, which can be a little bit trickier, but this market is offering, to me, some very obvious signals. You don't have to be a technical strategist like Kevin to figure it out. It's just very obvious when the economy stinks, there's no reason for a rally.
All right.
Okay.
Second half strategy.
Second half strategy. Okay. So now we're going to be starting to look for a market bottom. Okay. We're going to be looking for rebound in the economy in 2010. And an economic rebound begets the stock market rebound in late 2009. Now we're going to switch from, again, if you were more defensive or cash or shorting, we're going to start looking for some long opportunities, and the things that move the most are the most aggressive sectors. Small caps will outperform. Cyclicals, the steel and chemicals and things of that nature. Some of the great consumer brands, your Apples, your Nintendos, and people will start buying things again. Some retailers will start to benefit. And so we're going to completely switch gears from all this defensive mentality we've been hunkering down for over a year on, and we're going to start to go aggressive because as we've seen historically, the market, when we do find bottom, there is usually a 30 to 50% rebound in the year ahead. So I'm not going to guess which end of the range. I'll take either one. I'll take 30, right? Okay. I'll take 25, okay? I'm not picky that way, okay? And so if I were to say what my number one pick was for that rebound, it would be the Ultra ETF for the Russell 2000, which is small cap stocks, which is UWM. And so here again, the small caps are going to outperform, and they usually outperform by 10 or 20 points over the general market. And then you double that effort, given that it's an Ultra ETF, you could be looking at a 80 to 100% return if you do time the bottom correctly.
All right. Do you own that now?
I do not know because I am bearish right now.
Okay.
Because the market just pushed towards 9,000. I'm playing on the way down now.
Technicality, had to ask it for disclosure purposes. And Charles doesn't look like he's buying that trading thing for the first half of the year. What do you think?
It's interesting. Steve and I have had conversations, and we're actually mostly in agreement, which is rare because last year we were actually opposite agreement.
For which you owe me a steak dinner.
Not yet. I still have a couple days.
Yeah,
that's to the end of the year.
It's real. Bite my fingernails. Okay.
But let me just raise this point that we were talking about. We both talked about how it could be two different markets. The question is, when does somebody think about going from being short to maybe considering going long? What signs are you looking for to suggest maybe it's time to change?
As Kevin knows, and this is probably unfair to everybody else, I have one of the great timing stomachs in the world. And as someone who's been around the market for so long, I started investing when I was 13 years old, and my father helped me out with that. When I start, I can handle the downswings better than most, but when I start to question myself, okay, and I'm like, oh no, why am I even in the market? Maybe I should be selling, and I wait an extra day. So I usually walk over to Kevin's office. I'm like, that's capitulation. And so now I've learned not only just to hold on to those spells, but I've learned to buy into them. Okay, I've learned to trust my instinct. By the way, on the upside, I know it's time to sell when I start calculating my net worth. Okay, when I take the time to figure out all the things I own in the world, and this is my net worth, that is at the top. Okay, so they're great timing indicators.
So, Kevin, it's been stated in this segment here that you know a lot. What do you think about this strategy?
I think the strategy is interesting. I have a slightly different take, and I'm going to give my spiel in just a bit. But in regard to Steve's, probably one of the most accurate timing indicators, I tip my hat. Absolutely correct.
All right, so pretty much sounds like everybody's on the same page with you. Coming up in the next two parts of the roundtable, we will hear the spiels from Charles and Kevin. Stick with us. With everybody here at the roundtable, I'm Terry Ruffalo.